Episode 19, Trusts in a Changing Regulatory World. Hello, my name is Alexander von der Fellen, and welcome to Trusts Unpacked, where we strip away myth and marketing and explain in plain terms how trusts actually work in real families. For the last 20 years, I've worked as a fiduciary focused almost entirely on the architecture of trusts, the skill of trusteeship, and the challenge of long-term family governance, not as a technical exercise, but as a human one. In this role, I have advised hundreds of families, as well as institutions and advisors across the world. Alongside my advisory work, I'm a published author. I've recently completed a trilogy that reflects both the technical and the human dimensions of both the fiduciary and the private banking fields. Before we begin, a brief but important note. This podcast is provided for general information and discussion only. It does not constitute legal, tax, fiduciary or professional advice, and it should not be relied upon as such. As ever, you should always seek advice from appropriately qualified professionals in your relevant jurisdiction before making decisions or taking action. So let's begin. This is an important session because it addresses a reality around us that can no longer be treated as background noise. And I'm talking about the regulatory environment. Because the regulatory environment around trust has changed. It is changing. It's not incremental, it's structural, and it's permanent. Trusts are no longer the discrete private arrangements of old, sitting somehow beyond scrutiny. They are now visible, reportable, and increasingly interrogated. This session looks at the main regulatory pressure points affecting trust today and what trustees and advisors need to do in order to remain resilient, not reactive, resilient. So let's look at the general direction of travel in the world of trust today. Because before looking at specifics, it does help to understand the direction. And the direction is this: regulation is moving in one consistent direction. More transparency, more reporting, more information sharing, more accountability. This shift is systemic. Governments face relentless fiscal pressure. Data sharing, particularly with the advent of AI, is incredibly easy. And public tolerance for opacity has simply diminished. Trusts sit directly in that line of sight. Assuming that regulation will somehow soften is not a strategy. Planning must assume continued and increasing scrutiny. The first pressure point is transparency and beneficial ownership. We now have registers of beneficial ownership. We have disclosure of controlling persons, information accessible to authorities, and indeed sometimes beyond. The idea that trusts can exist invisibly is outdated. Privacy hasn't disappeared, but it has definitely changed shape. Advisors must be clear with families. Information will be disclosed. The question is simply to whom, when, and in what form. Poor explanation here leads to shock later. Shock leads to mistrust. Transparency does not undermine trusts, but misunderstanding it does. Let's look at reporting and the ongoing nature of compliance. Reporting is no longer episodic. It's continuous. Tax reporting, economic substance, anti-money laundering, and know your client obligations. Cross-border information exchange. Trustees are expected to know exactly where beneficiaries are resident, exactly where assets are located, how income and gains are characterized, and ignorance is not a defense. One of the biggest risks today to trusts is what I would call passive non-compliance, not deliberate evasion, but failure, a failure to keep pace. Trusts that were compliant at inception can very easily drift out of compliance over time. Advisors need systems, not memory. Regulators are increasingly interested in behavior, not just structure. Who really controls decisions? How discretion is really exercised? Whether trustees really act independently? Of course, this mirrors what courts have always done, and regulators are simply catching up. Let me give you an example of what real accountability, not paper compliance, looks like when it is tested modestly rather than theatrically. This is from my book, Trust, The Skill of Trusteeship in 16 Success Stories and One Failure. In 2015, I was contacted by advisors acting for a prominent family from the Southern Caucasus. Their patriarch had built a trading empire over decades, not through scale or visibility, but through reputation. And the problem at hand was not internal misconduct, it was exposure. A shifting regulatory environment, sanctions elsewhere in the network, and a careless press reference had created suspicion. As a result, bank accounts were paused. Partners hesitated. No one was accusing the family of wrongdoing. They simply stopped returning calls. Inside the family, reactions diverged. One brand, trained in marketing, wanted to rebrand aggressively and control the narrative. Another, more traditional, wanted to double down on heritage and visibility. A third, a lawyer, retreated into legal review and risk containment. Each response was, in itself, rational, but together they created paralysis. What the patriarch understood instinctively was that this was not a branding problem or a legal one at all. It was an accountability problem. Things had drifted over time. Nothing illegal had happened, but that was simply not enough. Accountability required him to step forward before anyone else forced the issue. He didn't blame his advisors. Instead, he insisted on understanding everything afresh. He revisited everything. Old ledgers were pulled out in reviews. Ownership chains were mapped. Dormant entities were unwound. Reporting was tightened. As a second step, we designed a fiduciary structure that consolidated assets and decision-making into a framework that could be explained calmly to any bank, any auditor, or any authority. Not aggressively defended, explained. When questions came, as they inevitably did, the family did not have to scramble. They responded with evidence, calmly. What this case reinforced for me is that accountability is not about reacting well under scrutiny. It is about preparing to be scrutinized. It is the discipline of being answerable even when no one is asking questions. Trustees who treat administration as mere paperwork hope that they will never be tested. Trustees who treat it as accountability know that one day they will be. That's why accountability lives here, in administration, governance, and reporting. Not because regulators care about neat files, but because trust, once questioned, can only be rebuilt with clarity, consistency, and the willingness to stand behind what you've done. Trustees who simply act as nominees attract attention. Settlors who retain informal control create exposure. The regulatory lens is now a practical one, not theoretical. What happens in reality matters far more than what documents say. When it comes to international families, they face multiple reporting regimes, conflicting classifications, and different cultural assumptions about trusts. Here, information shared in one jurisdiction may trigger review in another. Advisors must therefore coordinate. Local optimization without global awareness is dangerous. This isn't about perfection. It's about coherence. Trusts that are logically consistent across jurisdictions tend to survive scrutiny far better than those that are aggressively optimized but in isolation. So how do you build regulatory resilience? It doesn't come from clever structuring. It comes from discipline. It comes from clear governance, independent trustees, consistent decision-making, robust administration, regular review. Trusts that are well run rarely attract regulatory difficulty, even in the toughest of environments. Those that rely on opacity or inertia eventually do, and advisors add the most value here, not by finding clever loopholes, but by maintaining alignment between intent, structure, and behavior. One of the most important adjustments we all have to make in this world, and advisors particularly, is psychological. For decades, many trusts were able to operate within what might be called passive privacy. Information did exist, but it was never actively demanded. Structures were disclosed only when absolutely required. Questions were episodic at best. That era has passed. Privacy now exists, but within a framework of disclosure. Information is assumed to be accessible to authorities. Cross-border exchange is now routine. Digital trails are now permanent. The question is no longer whether information will be seen, it is whether it will be understood in context. Another structural shift is the convergence of tax enforcement and anti-money laundering regulation, because in many jurisdictions, tax evasion is money laundering. Historically, they were separate domains. Now they overlap. Beneficial ownership registers feed tax authorities. Anti-money laundering reviews trigger tax inquiries. Cross-border reporting regimes, such as the automatic exchange of information, ensure that discrepancies are visible. Trustees can no longer treat tax compliance and anti-money laundering compliance as parallel tracks. They are the same track. For example, inconsistencies in beneficiary reporting can generate both tax exposure and anti-money laundering concern. A trust that misclassifies distributions may attract scrutiny not only from banks questioning the source of funds, but also from revenue authorities. Also, regulation is no longer purely technical, it's geopolitical. We live in a world of constant conflict and tension, and sanctions play a huge role in that. And those regimes evolve rapidly, instantly. Politically exposed persons face intensified scrutiny. We hear all the time about debanking scandals. Jurisdictional risk assessments shift based on global events and alliances. Trustees managing cross-border families must now monitor geopolitical developments as part of their fiduciary discipline. Assets linked, even indirectly, to sanctioned entities or even to entities with just a nexus to certain countries can trigger asset freezes or, at the very least, reputational damage. Relationships with counterparties in volatile jurisdictions may invite, and often do invite, enhanced due diligence. This doesn't mean that trustees must avoid complexity, but they must monitor it. Geopolitical risk is not static. A jurisdiction considered stable today may be sensitive tomorrow. Advisors who treat compliance as a one-off exercise underestimate the incredible pace of change that we are living through. Regulatory resilience now includes geopolitical awareness. And regulation is no longer confined to statutes. Reputation has become an enforcement mechanism, particularly relevant when it comes to professional trustees with global organizations. Media exposure, investigative journalism, and public data analysis can generate scrutiny even when no legal breach exists. A trust may be fully compliant and yet face reputational challenge if its structure appears opaque or appears aggressive. Advisors must therefore consider not only legality, but the very optics of a trust. If a structure were described publicly in simplified form, would it appear unreasonable or defensive? Would it reflect stewardship or concealment? Trustees who view their operations as defensive invite suspicion. Trustees who operate transparently within legal boundaries tend to diffuse it. Reputation and regulation are now intertwined. But there is another risk. And that is the risk of over-engineering. There's a temptation in a tightening regulatory environment like the one we live in to respond with complexity, additional entities, additional layers, additional technical provisions designed to anticipate every possible question. Now, I understand this instinct, but it is so often counterproductive. Over-engineered structures create interpretive risk and scare people. They increase administrative burden. They multiply reporting obligations. They invite misunderstanding. Resilience rarely comes from complexity. It comes from coherence. Trusts that are simple enough to explain, yet robust enough to function, tend to survive scrutiny far better than those designed to outpace it. Advisors can add value here by reducing unnecessary layers, not adding them. The discipline is to ask, does this feature actually serve a purpose, or does it simply serve an anxiety? So what are the behavioral red flags from a regulatory perspective? Because there are certain behavioral patterns that attract attention consistently. Some of them are trustees who never exercise independent judgment, settlers who direct decisions, even informally, distributions that contradict documented policy, minutes that appear somehow formulaic rather than substantive, trustees who rely excessively on external instructions. Those patterns suggest nominee behavior. Courts have always scrutinized such arrangements and interpreted them incredibly negatively. Regulators now do as well. So advisors must train trustees to understand that independence is not a rhetorical concept. It must be demonstrable. Decision-making processes should show deliberation. Alternative options should be considered. Conflicts should be recorded and managed. There's also a new aspect, and that is the fact that through technology, we have data permanence. Digitalization and the advent of AI has transformed regulatory capacity. Information is almost instantly searchable. Datasets are cross-referenced. Historical findings are retrievable. Inconsistencies will be found out. This increases the importance of data integrity. If a trust reports beneficiary information in one format to a tax authority and in another format to a financial institution, discrepancies will surface. Administrative systems, therefore, must be robust. Updates must be timely. Changes in beneficiary circumstances must be recorded systematically. Memory is simply inefficient and insufficient. Systems are essential. Advisors occupy a delicate position in this environment. Families often look to advisors for reassurance, but that's not their role. Trustees rely on advisors for interpretation. Regulators expect advisors to understand obligations. The temptation to reassure is strong, but false reassurance is corrosive. Advisors must communicate candidly about risk early. They must resist the instinct to minimize regulatory exposure in order to preserve their clients' comfort. In the long run, credibility matters far more than optimism. A family that understands the regulatory landscape clearly is more likely to cooperate in maintaining compliance. A family that feels misled will eventually lose confidence. Trust-based advisory relationships require realism, just like any relationship. So what I recommend is periodic regulatory health checks. Not triggered by crisis, not triggered by audit, but scheduled. These reviews should examine the following: beneficial ownership disclosures, tax reporting consistency, anti-money laundering documentation completeness, trustee independence and governance processes, cross-border reporting obligations, changes in beneficiary residence or status, and emerging sanctions exposure, inasmuch as it can be foreseen. The objective is not perfection. It is awareness. Trusts that undergo regular review rarely face surprise escalation. Silence doesn't equal safety. What happens when regulation conflicts with family expectations? Because there are moments when regulatory obligation conflicts with family instinct. A beneficiary may resist disclosure. Why do you need to know that? A settlor may object to reporting. A family may view transparency as some kind of intrusion. Trustees must stand firm. It's your duty. Fiduciary duty now includes regulatory compliance. Failure to meet it exposes not only the trust, but the trustee. Advisors must therefore prepare families for this tension in advance, right at the beginning. It's easier to explain at inception than during enforcement. Clarity at the beginning prevents conflict later. It's tempting to view current regulatory intensity as cyclical somehow, but the structural drivers suggest otherwise. Fiscal pressures on governments is unlikely to diminish, and that's putting it mildly. Data sharing infrastructure will only improve with the advent of AI. Public expectation of transparency will continue to rise. Trusts that adapt now will find stability later. Trusts that resist adaptation will face increasing friction. The long view requires acknowledging that regulatory scrutiny is not an anomaly, it's the environment. It's here to stay. So, in this changing regulatory world, the safest anchor remains the simplest. Go back to the first principles that we dealt with in the very first episodes of this series. Clear purpose, genuine independence, transparent governance, accurate reporting, documented reasoning. They aren't new requirements, they were always there. They're long-standing fiduciary expectations. What has changed is the enforcement intensity. So if you're a trustee who already operates according to these principles, you often find that regulatory evolution validates your discipline. Trustees who relied on discretion without documentation, however, are now exposed. The lesson is not defensive, it is constructive. Well-run trusts remain legitimate structures for family continuity, but they must be run well. There's another shift that we must recognize, and that is that compliance is no longer a technical function sitting at the edge of trusteeship. It's now a central pillar of governance culture. In this changing regulatory world, governance and compliance are now inseparable. The way trustees deliberate, the way conflicts are managed, the way decisions are recorded, the way instructions are confirmed, all of this now forms part of the compliance narrative. You see, when regulators review a structure, they're not simply asking whether filings were submitted. They're now asking whether the institution is coherent, whether it behaves consistently with its stated purpose, whether independence is genuine. This is cultural, not mechanical. Advisors therefore need to cultivate governance habits that reflect accountability in ordinary moments, not only under audit. If compliance is experienced as some kind of interruption to normal business, it will always feel burdensome. If compliance is understood, however, as evidence of seriousness, it strengthens authority. One of the most sensitive areas in modern trust regulation, well, not only modern trust regulation, but it's always been a central thing, is control. Who truly controls the assets? Who influences decisions? Who benefits in practice? Regulators have become increasingly skeptical of formal answers that seem to contradict the practical reality. If a settlor retains reserved powers, if trustees routinely defer to informal instructions, if investment decisions are effectively made elsewhere, then regulatory authorities may question the substance of the arrangement. Now, this isn't new in law. Courts have long examined sham or illusory trusts. What has changed is the frequency and breadth of regulatory attention. Advisors must therefore conduct honest assessments of control structures. Are the reserved powers narrowly defined? Are trustee deliberations independent? Is there evidence that trustees reject or modify proposals? Are conflicts of interest identified and managed? Control doesn't have to be eliminated, but it must be transparent and it must be defensible. The days of informal dominance masked by a kind of formal independence are over. It's tempting to view documentation as some kind of archive, but in reality, documentation is a narrative. Minutes tell the story of how decisions were made. Distribution resolutions explain the reasoning. Investment reviews demonstrate prudence. Conflict disclosures reveal transparency. When regulators review a trust, they're reading its story through documents. If the story is coherent, consistent, and thoughtful, confidence increases. If the story is fragmented, repetitive, or somehow formulaic, suspicion follows. Advisors should therefore train trustees to write minutes that reflect real deliberation, to articulate alternative options, to explain why a course of action was selected. This isn't defensive drafting, it's disciplined reasoning. Over time, documentation becomes the trust's institutional memory. And in a regulatory context, memory is protection. There's also an economic dimension to modern regulation. Financial institutions have become risk sensitive, and that's putting it mildly. Compliance departments operate under intense supervisory pressure. Remember, individual compliance directors are personally liable for accounts that are opened. I was once interviewing a compliance director from an offshore jurisdiction, and he told me that his greatest worry was an account opening or a transaction that he authorized today would lead to him in 10 years being arrested in Miami airport. So his default reaction was always to say no. He saw his role as the elimination of risk, not the control of risk. So you see, banks face penalties not only for wrongdoing, but for association with structures that are perceived as high risk. As a result, trustees must recognize that counterparties will often adopt conservative interpretations that somehow seem baffling. A bank may simply exit a relationship not because of any misconduct, but because of potential regulatory cost and potential reputational risk. They're worried more about what the intermediary or correspondent bank thinks of them than what the regulator does. Advisors therefore need to assess structures not only through a legal lens, but also through a commercial one. Trusts that are legally robust but commercially unattractive may also struggle operationally. Resilience includes commercial viability. Let's look at data integrity. Over time, small discrepancies in data can accumulate. A beneficiary changes residence, but reporting systems are not updated. A distribution is recorded differently across jurisdictions. A new asset is introduced without reviewing economic substance implications. Now, none of these errors may be serious individually. Collectively, however, they can create drift. In a digital regulatory environment, drift is visible. Advisors should therefore implement periodic reconciliation processes. Beneficiary data should be cross-checked across finance. Tax reporting should be compared with anti-money laundering records. Entity ownership diagrams should be refreshed on a regular basis. Now, this is not about anticipating wrongdoing, but it is about preventing administrative entropy. Drift is rarely dramatic. It is incremental. It is surreptitious. But incremental surreptitious misalignment is exactly what regulators are looking for and what they detect most easily. Of course, this all puts a burden on trustees, and as new trustees come into the industry, we need to ensure that we're training them properly. But not only new trustees, also existing trustees. Trustees themselves, you see, must evolve. Many trustees were trained in an era when discretion and confidentiality were the primary virtues. Don't get me wrong, those virtues remain important, but they now operate alongside transparency and documentation. Advisors should therefore ensure that trustees receive regular regulatory updates, not dense legal briefings, but clear explanations of emerging expectations. Trustees should understand the scope of reporting obligations, the consequences of inaccurate filings, the importance of behavioural consistency, and the reputational implications of scrutiny. Ignorance is no longer a credible defence. Professional trustees are expected to be informed. Lay trustees must be supported appropriately. The regulatory environment has raised the standard of care. One useful discipline is hypothetical stress testing, and I always recommend this. As an advisor, I would ask, if this trust were reviewed by a tax authority tomorrow, let's say, what would they see? If a beneficiary challenged trustee independence, what evidence would support it? If a journalist simplified the structure publicly, would it appear reasonable? If a bank conducted enhanced due diligence, what additional documents would be requested? Now, don't get me wrong, these exercises are not meant to be alarmist, but they are meant to be preventative. They shift thinking from technical sufficiency to practical defensibility. Trusts that survive this kind of stress testing internally are less likely to struggle externally. Think of it as a drill, like a drill on an aircraft carrier, a stand to in the army. It prepares you for the real action coming ahead. Regulatory pressure can expose underlying family tensions. A beneficiary asked to disclose personal information may well feel mistrusted. A settlor confronted with reporting obligations may well feel loss of control. A trustee required to challenge informal influence may well face relational strain. Advisors must manage this human dimension carefully. Regulation should not be presented as threat. It should be framed as context. The conversation should emphasize that regulatory compliance protects the trust and its beneficiaries by extension, that transparency, when properly managed, strengthens credibility. When families understand that compliance supports continuity, resistance tends to diminish. When compliance is framed as somehow a concession, intrusive, resentment grows. So the language does matter. I have to be candid about the cost of non-adaptation. There's consequences to inertia in today's environment. Trusts that fail to adapt face escalating friction. Banks may terminate relationships without more than a letter. Professional trustees may simply resign. The trust may be left in limbo whilst a new trustee is sought. Regulators may impose serious penalties. Beneficiaries may initiate litigation. Even when legal exposure is limited, reputational cost can be severe. And in today's environment, where many fiduciary companies are global organizations, global businesses, reputational cost is real cost. Adaptation, by contrast, is rarely dramatic. It involves incremental upgrades, process improvements, clarification of role, regular reviews. The cost is modest compared to the cost of enforcement. Resilience is not free, but it's far, far cheaper than remediation. And in this environment, advisors must reposition themselves. The value proposition is no longer centered on technical structuring alone and clever loopholes. It's centered on coherence. As an advisor, you must ensure that the trust's purpose remains clear. Governance behavior aligns with documentation. Reporting is consistent across jurisdictions. Trustees understand evolving expectations, and families are prepared for disclosure realities. This is strategic stewardship, not reactive compliance. Clients who seek advisors purely for optimization may be disappointed. Clients who seek advisors for durability will understand the distinction. Let's try and have a broader perspective. it's easy to view regulation as adversarial. The broader perspective suggests otherwise. Modern regulation reflects societal expectations around fairness, transparency, and accountability. Trusts exist within society, they're not external to it. Well governed trusts serve legitimate purposes: family continuity, asset protection, intergenerational planning, philanthropic activity. Now, regulatory scrutiny doesn't invalidate those purposes, it simply challenges trustees to demonstrate seriousness. In that sense, regulation may strengthen well run trusts. It filters out the structures designed primarily for opacity. It rewards clarity. It encourages documentation. Advisors who embrace this perspective operate from confidence rather than defensiveness. So, what does all of this mean in practice? Well, it means that advisors must change posture. In the past, advisors were often rewarded for ingenuity, for finding efficient routes to hide things, for designing elegant structures that achieved legitimate objectives, but with minimal friction. Now, that skill still matters, but it's no longer sufficient. Today, the most valuable advisors are those who think in systems rather than mere transactions, who understand that every structure will eventually be examined, not only for legality, but for coherence, who prepare clients not just for formation, but for endurance. And that requires three disciplines. First of all, intellectual honesty. Advisors must confront weaknesses in existing structures without defensiveness. If a trust has drifted administratively, that must be acknowledged. If control dynamics are misaligned with documentation, that must be addressed. Avoidance simply compounds the risk. Second, anticipatory governance. Simply waiting for a regulator, a bank, or a court to raise questions is reactive. Advisors should raise them first. They should ask the uncomfortable questions before someone else does. That's not alarmism, it's professionalism. Second, family education. Many families still operate with outdated assumptions about the privacy and discretion they have the right to. Advisors must recalibrate these expectations, not dramatically, not in any way confrontational, but clearly. The environment has changed. Structures must reflect that change. The advisor's role is not to shield clients from reality. It's to help them operate within it intelligently. Now, I've said all of this and it sounds quite, well, alarmist. I don't mean it to be. And in fact, my next point is precisely the opposite. And that's that regulatory intensity can create anxiety. Media narratives amplify that anxiety. I grant you that. Clients may fear exposure. Trustees may fear liability. Anxiety is understandable. But panic is not useful. The discipline you now require is calm review of structures, calm reconciliation of reporting, calm classification of governance, calm communication with families and counterparties. Most regulatory problems escalate not because of complexity, but because of panicked defensive reaction. When trustees respond slowly, consistently, and with documented reasoning, scrutiny tends to narrow. When they react emotionally or evasively, scrutiny widens. Calm isn't passivity, it is controlled engagement. And in a changing regulatory world, controlled engagement is strength. Trusts aren't relic of a more opaque, more gentlemanly era. They remain legitimate, powerful instruments of family continuity and stewardship. But legitimacy today depends on visibility, managed with discipline. Transparency is structural. Reporting is now continuous. Behavior is now examined. Documentation is now permanent. Reputation is now intertwined with regulation. But don't get it wrong, this is not a hostile environment. is just an exacting one. The trusts that will endure will be those that align purpose, governance, and administration coherently over time. The advisors who endure will be those who help families adapt early rather than defend late. And the trustees who endure will be those who understand that scrutiny is not an interruption of their work. It's part of their work. It's what advisors need to watch, not the next rule change, but the deeper shift in societal expectation. The regulatory world will continue to evolve. Things will not get easier. Resilience will continue to depend not on cleverness, but on clarity. So let's draw out the key takeaways from today. First, the direction of travel is clear and consistent. More transparency, more reporting, more data sharing, more behavioral scrutiny. And this is not temporary, it's structural. Advisors who assume the pendulum will somehow swing back to happier times are planning for a path that will not return. Secondly, privacy has not disappeared. It has evolved. Trusts are no longer invisible. Information is accessible to authorities and often shared across borders. The task is no longer concealment. It is coherent explanation. If a structure cannot be explained calmly to a bank, an auditor, or a regulator, it is simply not resilient. Third, compliance is no longer episodic. It is continuous. Tax, anti-money laundering, economic substance, sanctions, exposure, cross-border exchange, these regimes all intersect. Inconsistency is now one of the greatest risks. Advisors must move from memory-based administration to systems-based discipline. Fourth, behavior matters far more than paper. Regulators and courts alike look beyond drafting to the reality. Who controls decisions? How is discretion exercised? Are trustees genuinely independent? Are conflicts documented? A technically elegant structure, undermined by what can be called nominee behavior, will not withstand scrutiny. Fifth, cross-border families face compounded complexity. Local optimization without global awareness creates exposure. Sixth, regulation and reputation are now intertwined. Media, data analytics, and public registered mean that perception influences response. Structures must not only be lawful, but defensible in both tone and substance. Seventh, data integrity is a fiduciary function. Minor discrepancies accumulate, a change in residence unrecorded, a distribution classified differently across systems. Individually small, collectively problematic. Eighth, advisors must reposition themselves. The value today is not primarily in finding clever routes, it is in ensuring alignment. Ninth, trustees must be trained for this new environment. Ignorance is not a defense. Independence must be demonstrable. 10th, resilience is cheaper than remediation. Periodic regulatory checks, stress testing structures hypothetically, reviewing control dynamics, reconciling data, these disciplines may feel cautious, but they are prudent. And finally, this environment calls for calm. Regulation can generate anxiety. Clients may fear exposure, but anxiety clouds judgment. Trusts remain legitimate and valuable instruments of stewardship. They enable continuity. They structure responsibility. They support families across generations. But legitimacy now requires visibility, managed with discipline. Transparency is structural. Reporting is continuous. Behavior is examined. Documentation is permanent. The trusts that endure will be those that accept this reality early. The advisors who endure will be those who prepare families honestly. And the trustees who endure will be those who understand the scrutiny is not an intrusion into their role. It's a part of it. That was Trusts in a Changing World, Unpacked. Join me for our next 20th and sadly our last episode in this series to look ahead and unpack the trust of the future as a long-term institution, an attempt to look together into that risky, uncertain future. Until then, I am Alexander von der Fellen.